Tonight, we are going somewhere else. Not medieval ramparts, not lantern-lit stone corridors, though those places have their charms. Tonight we are stepping into a world that is both closer and, in some ways, stranger than any castle. We are going to the 1970s, to the smell of percolating coffee in a kitchen that still has avocado green appliances, to the sound of typewriters, to the particular hum of fluorescent lights in a bank lobby at 9:30 on a Tuesday morning, to the moment a woman sat down across from a loan officer, her paperwork immaculate, her credit history perfect, her salary higher than her husband's, and was told, with the calm certainty of someone reading from a rulebook they had never once questioned, that her income could not be counted, because she might get pregnant. That was the actual reason they gave. Settle in now, arrange yourself into comfort. The world outside your window is doing what it always does. Here, in this quiet space between wakefulness and sleep, we are going to follow the stories of women who walked into banks, told the truth, handed over the evidence, and were handed back a polite no. We are going to understand how a financial system that was supposed to be about numbers, objective, impartial numbers, managed to ignore a great many numbers for a very long time, and we are going to do it gently, in the slow, unhurried way of a story told by firelight, without urgency, without alarm, drifting toward stillness. If you enjoy listening to long, slow history stories like this one, please consider subscribing. New stories arrive every week, and they will always be here when you need them. Now, let us begin. To understand what happened in the banks of the 1970s, you have to understand the world that built those banks. Not just the architecture, the grand marble lobbies, the brass teller windows, the leather chairs set at careful angles in the loan officer's office, but the invisible architecture, the structure underneath the structure, the set of assumptions so deeply held that they had calcified over decades and decades into something that felt like simple reality, like the way things were and had always been and would probably always be. That world was built on a story, not a malicious story necessarily, though it had its malicious elements, as all stories do when they are used to justify unequal treatment. It was, at its core, a story about what a family looked like, about what money was for and who was supposed to manage it, about the proper relationship between a man and a bank, and the question of whether women entered into that relationship at all. The story went like this. A family was a unit. At the centre of that unit was a man. The man worked. The man earned. The man went to the bank and the bank spoke to the man, and together they arranged the financial life of the family with the steady, rational clarity of two parties who understood each other perfectly. The woman in this story was also important, essential even, but she operated in a different sphere. She managed the home, she raised the children, she shopped and cooked and kept things clean and made sure the man had what he needed to go back out into the world and earn more money that she would then manage into groceries and school clothes and doctor's appointments. This was not, in many households, an inaccurate description of how things actually worked. It was a real arrangement that real people lived out with real contentment or real resignation or some complicated mixture of both, depending on who you were and what you wanted. The problem was not that this story existed. The problem was that it became the only story, the only template, the only shape that a life could be allowed to take when it arrived at a bank counter and asked for a loan. And that meant that any life which did not fit the template, any woman who worked outside the home, any woman who earned her own money, any woman who wanted to purchase property on the basis of her own income and her own credit and her own demonstrable capacity to repay a debt, that woman was, in the logic of the financial system, a kind of anomaly. Not necessarily hostile, not necessarily to be dismissed, but to be regarded with caution, to be measured against a template she did not fit and found lacking in ways that had nothing to do with her actual finances and everything to do with the fact that she was not quite the person the system had been designed to serve. Let the weight of that settle for a moment. You are tired. The day is behind you now. This is not a story you have to fix tonight. It has already been fixed imperfectly by the people who came before you. You just need to understand it, to hold it gently in your mind as you drift. The story of American home ownership is also the story of American stability. For the middle class that emerged from the Second World War, owning a home was not simply a financial transaction. It was the transaction, the foundational act that converted a working person into a stable person, a renting person, into a stakeholder, a temporary arrangement into a life. The suburbs that fanned out from every major American city in the post-war decades were not just collections of houses. They were, in a real and tangible way, the material form of a promise. Work hard, save carefully, take out a mortgage, pay it back, own something, belong somewhere, pass it on. The GI Bill, which offered returning veterans low-cost mortgage loans in the years after 1944, made this transaction available to millions of men who might otherwise never have been able to afford it. The Federal Housing Administration, which insured mortgages and thereby encouraged banks to lend more freely, expanded the pool further. The 30-year fixed-rate mortgage, which spread payments over a long enough period that the monthly figure became manageable on a single income, became the mechanism by which the American dream was delivered, house by house, lawn by lawn, suburb by suburb, across the breadth of a country that was building itself into a new shape. It was by many measures a remarkable achievement. It was also an achievement that was carefully, systematically, often explicitly structured to exclude certain categories of people. The racial dimension of this exclusion has been well documented. The practice of redlining, the FHA's explicit encouragement of racially segregated neighbourhoods, the real estate covenants that barred black families from purchasing homes in the very suburbs the GI Bill was helping to build. That story is long and complex and worthy of its own telling on another quiet night. Tonight we are concerned with a different exclusion, less explicitly codified but no less real in its effects, the exclusion of women. Not all women, not explicitly. There was no rule that said women could not own property, had not been such a rule, in most places for some decades. The common law doctrine of coverture, which had once subsumed a woman's legal identity into her husband's upon marriage, had been formally dismantled in the 19th and early 20th centuries. Women could own property. Women could sign contracts. Women could, theoretically, borrow money. The problem was more subtle than a rule. It was a practice, a set of practices embedded in the daily operations of lending institutions, backed by the quiet logic of actuarial tables and professional custom that systematically discounted women's financial credibility in ways that amounted, in practical effect, to the same thing as a rule. Let us go back to the bank. Let us go slowly and look carefully at what was happening there. The process of applying for a mortgage in the post-war United States was, on its face, a rational process. You gathered your documents, you demonstrated your income, you provided evidence of your credit history, your record of paying back debts on time, of handling financial obligations responsibly. You sat down with a loan officer, and the loan officer evaluated your application according to a set of criteria, and then a decision was made. The criteria were supposed to be objective: income, debt-to-income ratio, credit score, down payment, employment history. These were numbers. Numbers were supposed to be impartial. But numbers do not interpret themselves. Numbers require human beings to decide which numbers count and which do not, how to weight them, how to project them forward into an uncertain future. And those decisions were made by human beings who had grown up in the same world as everyone else, absorbed the same stories, internalized the same template about what a family looked like, and who was supposed to be earning money and what that money was likely to do over the next 30 years. When a married woman's income appeared on a mortgage application, the question the loan officer asked was not the question he asked about a man's income. The question was not, can this person afford this loan? The question was, will this income last? And the answer, shaped by the template, was, probably not, because she might get pregnant, because pregnancy meant stopping work, because stopping work meant a reduction in household income, because a reduction in household income meant a higher risk of default. Therefore, discount her income. Halve it, if you like. Ignore it entirely if you prefer. Either way, you were only being prudent. The math of it felt reasonable if you accepted the premises, but the premises were doing enormous work. The premise that women would get pregnant, the premise that pregnancy would mean stopping work, the premise that the current moment was not what mattered, but rather a future moment in which the woman would have been transformed by biology into a different kind of economic actor. The premise that this transformation was so likely, so inevitable, that it had to be priced into the mortgage decision right now, regardless of what the actual woman in the actual chair across the desk actually planned to do with her life. No one asked what she planned, or if they did, they asked in a way that made clear the answer did not matter. The template was more powerful than her testimony about herself. Breathe in, slowly, breathe out. You're warm where you are. The story continues. It is 1971. The year is not chosen at random. A lot is happening in 1971 that is relevant to where we are going, but we will get there gradually. For now, the year is 1971, and a woman is walking into a bank. Her name is not important for the purposes of this story. She's a composite, drawn from the real experiences of real women who left records, in court documents, in congressional testimony, in letters to newspapers, in memoirs written decades later, when the whole episode had become historical enough to be narrated with a certain wry distance. She's every woman who walked into a bank in those years and encountered the machinery of the template. She's in her early 30s. She's been working for 8 years, first as a secretary, then as an office manager, then as an administrator at a mid-sized company in a mid-sized city. She earns a respectable salary. She's good at her job. She has, over the years, been careful with money. Careful in the way that people who did not grow up with money learn to be careful, which is with a precise and constant attention to what is coming in and what is going out, and what the margin between them looks like. She has a bank account. She has a savings account. She pays her bills on time. She has never in 8 years failed to meet a financial obligation. She's married. Her husband also works. Together they earn considerably more than the median household income of 1971, which was approximately $10,000 per year. They are, in the language of the time, comfortable. They are also, in the language of the time, renters, which means that their money goes every month to a landlord who is building equity while they are building nothing. She wants to change this. She has identified a house. It is a modest house in a neighbourhood that is neither particularly fashionable nor particularly run down. It has a yard. It has 3 bedrooms. It has a kitchen that does not have avocado green appliances, which she considers a point in its favour. The asking price is within range of what she and her husband can afford, based on the mortgage payment they would need to make every month versus the income they both bring home. She has done the math carefully. She's good at math. She does math at work all day. The numbers work. She makes an appointment with the loan officer at her bank. She arrives with a folder of documents. She's dressed professionally because she goes to the office on most days and is coming from work. She sits down across the desk from the loan officer, who is a man in his 50s who has been doing this job for a long time and who is, in his own estimation, and probably in the estimation of most people who know him, a reasonable and fair-minded person. She presents her application. She presents both their incomes. She explains their household finances. She notes her 8 years of employment history, her clean credit record, her savings. The loan officer looks at the application. He nods at appropriate moments. He is pleasant. He is not hostile. He is, if anything, a little avuncular, the manner of a man who has seen many applications and can tell when things are in order, and is satisfied to find them so. Then he says something that she will remember with absolute clarity for the rest of her life. He says that her income cannot be counted. She says, "I beg your pardon." He says it again, more fully this time. The policy of the bank, not his policy, he's careful to say, but the bank's policy, is that a wife's income is not counted, or is counted only at a fraction of its face value when calculating a household's capacity to service a mortgage. The reason, he explains, is pregnancy. Not that she is pregnant, not even that he thinks she is likely to become pregnant, simply that the possibility exists, that it is a category of risk that the bank has determined must be factored into its calculations. She sits with this for a moment. She's not pregnant. She has no plans to become pregnant. She has, in fact, discussed this with her husband, and they have made a decision together about the shape of their family, a decision that does not involve the imminent arrival of children. She would be happy to explain this, if it would help. It would not help, the loan officer says, not unkindly. The policy is not about her individual circumstances. It is about the category of wife, the category of woman of childbearing age. The category carries a risk. The risk is priced in. She thinks about asking whether the same logic applies to her husband's income, whether the fact that he could at any moment be struck by a car, or develop a chronic illness, or simply decide to quit and try something else, was similarly priced in. She decides not to ask. She has a sense that the question, however logical, would not land well. Instead, she asks what this means for their application. It means, the loan officer explains, that the mortgage they can qualify for is based on her husband's income alone, or, in some interpretations, on her husband's income plus some portion of hers, a fraction, perhaps a half, that represents the bank's estimate of what portion of her income could reliably be expected to continue over a 30-year period. She does the math instantly. She's good at math. The number he is describing is considerably lower than the purchase price of the house she wants to buy. She thanks him. She gathers her folder. She walks out of the bank. That evening she and her husband discuss it. He is outraged in the way that men who love their wives and consider them equals are outraged when their wives are treated as something other than equals. He suggests writing a letter. She writes several drafts of the letter and does not send any of them, because she cannot figure out who to send them to. The bank has not broken any law. What it has done is simply the way things are done everywhere by every bank across the entire country. She does not stop wanting the house. She does not give up. What she does instead is part of what we will follow tonight. There were variations on this scene playing out in bank lobbies all across the United States throughout the 1960s and into the 1970s. The details shifted. Sometimes the woman was single, and the problem was different, not pregnancy per se, but simply the category of single woman, which the financial system regarded with a suspicion whose precise nature was difficult to articulate, but was nonetheless absolutely consistent in its application. Sometimes the woman was a widow, trying to take on a mortgage in her own name after decades of joint home ownership, and discovering that the credit history she had built with her husband did not transfer to her because it had never been in her name. Sometimes the woman was divorced. Divorce was one of the most financially devastating things that could happen to a woman in this period, not because of the emotional cost, though there was that too, but because of the credit cost. A woman who had been married for 20 years and had faithfully paid every bill, every credit card statement, every loan installment, found upon divorce that she had no credit history. None. Because all the accounts had been in her husband's name. His credit score had been built on her financial discipline. She was, in the records of the financial system, a ghost. The single woman's problem was also real and also strange when you looked at it closely. A single woman who worked, who earned, who had her own apartment and paid her own rent and managed her own finances, was regarded by lenders as a category of risk that a single man of equivalent income was not. The reasoning was not always stated as clearly as it was in the married woman's case. It was more diffuse. It had to do with the assumption that a single woman's income was temporary, that she would sooner or later get married, and once married, would stop working. It had to do with the sense that a woman alone was not a complete economic unit in the same way that a man alone was. It had to do, at its root, with the template. The template said that the basic unit of economic life was the male breadwinner with a family to support. Everything else was a deviation. Deviations required extra scrutiny. Deviations were, by definition, less reliable. The effects of this were not theoretical, they were material. They meant that women who could have afforded mortgages did not get them. They meant that women continued to rent when they could have been building equity. They meant that the wealth gap between men and women, already substantial, was reinforced and extended with every year that passed under these conditions. A house is not just a place to live. A house is an asset that appreciates, an asset that can be borrowed against, an asset that can be passed to children. Every year that a woman was kept out of home ownership was a year of compound interest that accrued to other people's accounts. Let the story breathe for a moment. You are comfortable. You are warm. The details are settling into you like water into cloth. There is no rush. The story goes on. To understand how the mortgage discrimination of the 1960s and 1970s worked, it helps to understand that it was, in most of its daily operations, entirely unremarkable. It was not, for the most part, the product of conscious malice. It was not men sitting in rooms deciding to harm women. It was something more banal and in some ways more impervious to challenge. It was standard operating procedure. Banks had underwriting guidelines. Those guidelines had been developed over years, based on the accumulated data about which loans had defaulted and which had not. The data showed, or appeared to show, certain patterns. Women's incomes were less reliable than men's, the data suggested. Therefore, women's incomes should be discounted. The problem with this analysis, which would become clear only gradually and only under pressure, was that the data was not a neutral record of natural patterns. The data was itself the product of the conditions it was being used to describe. Women's incomes had been less reliable in the past, partly because women had fewer opportunities, partly because married women had historically been expected to stop working, partly because the entire economic structure had been arranged in ways that made women's paid employment contingent and secondary, in a way that men's was not. The data reflected all of that, but it reflected it as though it were immutable fact, as though the patterns of the past were fixed laws rather than the residue of particular social arrangements that were already, by the time the underwriters were consulting the data, beginning to change. The women of the early 1970s were working in larger numbers than ever before. The women of the early 1970s were, in many cases, planning to continue working through marriage, through early motherhood, through everything. The world was shifting. But the data in the underwriting guidelines was static. It described a world that was already becoming the past, and it was being used to make decisions about the present, and it was calibrated to produce results that fit the template, rather than to describe the actual financial circumstances of the actual people sitting in the actual chairs. There is a word for this. The word is discrimination. It is a word that can describe both intentional and unintentional harm, which is useful, because both varieties were at work here simultaneously. Some of the men who ran banks genuinely believed that women were bad financial risks. Some of them had no particular opinion about women and were simply following guidelines they had inherited and never examined. Some of them, when pressed, would have said they had nothing against women. It was just the numbers, just the data, just the way things worked. What they were less likely to say, or perhaps to see, was that the guidelines they were following were not natural laws. They were choices. They had been made by specific human beings at specific moments in history, on the basis of assumptions that could have been different, and were, in fact, different in other places and other times. They were choices that had real consequences for real people, and those consequences fell disproportionately on women. Consider the mechanics of credit scoring, which is the system by which banks assessed an applicant's history of meeting financial obligations. Credit scores, or what would later become formalized as credit scores, were based on records maintained by credit bureaus. Credit bureaus tracked accounts in the name of whoever held the account. For most of the post-war period, in most households, accounts were held in the husband's name. The wife might have a separate credit card account. Many women did. But the primary accounts, the mortgage, the car loan, the major credit lines, were in his name. This meant that even in households where the woman was the more financially disciplined member, where she was the one who actually sat down every month and paid the bills, the credit history being built was his. When the marriage ended, by death or divorce, the credit history went with him, or it went nowhere because he was gone. She was left without a record. The financial system did not see her history because it had not been tracking her. The practice of building separate credit histories was, for most women in this period, not something they thought about as a conscious strategy, because the conditions that made it necessary were invisible to them until the moment they became visible. The moment of a husband's death, or the end of a marriage, or the first solo attempt to borrow money. By then, it was too late to go back and build the record she should have been building all along. Consider also the particular problem of the single career woman. She existed in increasing numbers by the 1960s. A woman who had chosen to remain unmarried, or who had not yet married, or who was between relationships, who was supporting herself entirely on her own income and living the kind of independent urban life that had not existed as a widespread social possibility even a generation before. She was a new kind of person, at least in demographic terms. The financial system had not quite figured out what to do with her. What it often did was apply a category: unmarried woman of childbearing age. The assumption embedded in this category was that she would, inevitably, get married and stop working. The transience of her unmarried status was taken as the transience of her earning status. She was preparing to stop being economically independent, even if she herself had no such plans. The practical result was that some lenders required single women to have male co-signers on loans. The male co-signer was a kind of insurance against the assumed fragility of the woman's financial independence. He was also, in a structural sense, a reassertion of the template, the reminder that behind every woman there needed to be a man whose economic credibility would stand behind hers. The requirement was not universal. Not every bank required it. Some banks were more progressive than others, some loan officers more willing to evaluate applications on their individual merits, but the requirement was common enough to be encountered regularly, and its very existence was a message. The message was that a woman alone was not enough. Close your eyes a little more. The story is long, and it has time. We're only in the middle of the landscape. There are mountains ahead, and they are not so very high, and we will cross them slowly, and on the other side there is the quieter country of what changed and why. The credit card is worth pausing on, because credit cards are where a lot of the everyday experience of financial discrimination played out, and credit cards were the precursors to the mortgage conversation in important ways. The bank credit card, as a consumer product, expanded rapidly through the 1960s. By the early 1970s, most Americans who were bankable had access to some form of revolving credit. Credit cards were useful, and people wanted them. Women wanted them too, and women, particularly married women, discovered that getting one in their own name was surprisingly difficult. The standard practice at many banks was to issue cards to the husband only. If a wife wanted a card, she could sometimes get a supplementary card on his account, a card that was linked to his account, his credit line, his record. The record built by her use of that card would accrue to him, not to her. Some banks would issue cards to married women only if their husbands signed the application. Some required that a woman have her husband's permission to apply. This was not illegal. At the time, no law specifically prohibited it. The Equal Credit Opportunity Act, which would eventually change these practices, did not exist yet. Banks were doing what banks had always done, which was apply the template, serve the assumed customer, and treat deviations from the template as problems to be managed rather than customers to be served. The experience of applying for credit in your own name and being told you could not have it, or could have it only with a man's permission or signature, was one of the formative experiences of the women's movement in this period. Not the most dramatic experience, perhaps, not arrest or violence or the loss of bodily autonomy, but it was the experience that made the financial dimension of inequality concrete and personal in a way that was hard to argue away. You had a job, you earned a salary, you paid your bills, you had proven empirically that you were a responsible financial actor. And the institution across the desk from you looked at all of that and said, not quite enough. The specific grinding daily quality of that experience was different from the more dramatic confrontations of the civil rights era. It was paperwork, it was policies, it was the polite but implacable machinery of a system that had been built without you in mind and would continue to operate without you in mind unless someone made it stop. The women who fought back against this system came from many different directions. Some of them were lawyers, some of them were activists, some of them were academics who studied economics or law or sociology, and were, in the process of studying, driven to a kind of quiet, focused determination by the gap between what the system claimed to do and what it actually did. Some of them were simply ordinary women who had encountered the machinery of the template and refused, on principle, to accept that it was either natural or permanent. Let us begin with the lawyers, because the lawyers are where the legal change came from, and because among the lawyers there is one figure whose story threads through so much of what happened in these years that it would be impossible to tell the story properly without her. Her name was Ruth Bader Ginsburg. She was, in the early 1970s, a law professor at Rutgers and then at Columbia, and she was also the co-founder and director of the ACLU Women's Rights Project. She was methodical, she was strategic. She approached the problem of legal discrimination against women the way a chess player approaches a difficult board, with patience, with a long view, with the understanding that some moves set up other moves that will not come for several years. Ginsburg had studied the way Thurgood Marshall and the NNAACP Legal Defense Fund had approached racial discrimination, case by case, building a body of precedent, choosing cases carefully to make the strongest possible constitutional arguments, and then using the resulting decisions to support the next case and the next. She applied this method to sex discrimination. She would identify the right cases, she would brief them carefully, she would argue them before the Supreme Court, she would, over the course of several years, build a framework of constitutional law that said that the Equal Protection Clause of the 14th Amendment applied to sex-based classifications, not just racial ones. The first great case was Reed versus Reed, decided in 1971. It seems simple now, almost absurdly simple. An Idaho law said that when two people of equal legal qualification were candidates for administrator of an estate, Preference would be given to males. The estate in question was that of a child who had died. The two candidates were the child's mother and father, who were separated. The Idaho court applied the statute and appointed the father. Sally Reed appealed. Ginsburg wrote the brief. She argued that a law which automatically preferred men over women on the basis of sex alone was a violation of the Equal Protection Clause. The Supreme Court unanimously agreed. Chief Justice Warren Burger wrote that arbitrary preference based on sex alone was prohibited by the Constitution. It was not a dramatic ruling. It did not immediately change daily life in banks or anywhere else. But it established something important, that sex, like race, could not be used as an automatic disqualifying criterion, that a person could not be disadvantaged simply because of their sex, without any inquiry into their actual individual qualifications. Ginsburg followed Reed with more cases. Frontiero v. Richardson, 1973. Weinberger v. Wiesenfeld, 1975. Each case was carefully chosen. Each case featured a provision of the law, a federal statute, a state regulation, that treated men and women differently on the basis of nothing except sex. Some of these provisions actually harmed men, which was a deliberate strategy. Ginsburg knew that a Supreme Court composed entirely of men would be more likely to see the arbitrariness of sex-based classifications if they could be shown a case where a man was disadvantaged by them. In Weinberger v. Wiesenfeld, for instance, the plaintiff was Stephen Wiesenfeld, whose wife had died in childbirth. He wanted to collect Social Security survivor benefits so he could stay home and care for their infant son. But the Social Security Act provided survivor benefits to widows but not to widowers. He was denied. Ginsburg argued his case. She argued that the classification harmed both men and women. It denied Wiesenfeld the benefits he deserved as a surviving parent, and it valued his wife's Social Security contributions less than it would have valued those of a man in the same position. The court agreed. The discriminatory provision fell. What Ginsburg was doing, case by case, was teaching the Supreme Court to see sex discrimination where it had not seen it before. She was building a framework, brick by careful brick, in which the automatic assumptions of the template, that women were different in ways that justified treating them differently across all aspects of economic and civic life, could be examined, questioned, and dismantled. The work was slow. It required patience of a particular steely variety. The patience of someone who knows that the right outcome is coming but cannot know exactly how long it will take to arrive. It required the ability to hold a long-term strategy in one hand and a specific suffering person's case in the other, and to find the intersection between them without losing sight of either. It also required, on the part of the litigants, the women and occasionally men whose cases became the vehicles for constitutional change, a willingness to have their personal circumstances become the material of legal history, to sit in a courtroom and have the facts of their family life, their finances, their income, their marriage, debated by lawyers in front of judges who would decide in a proceeding that had nothing to do with them personally and everything to do with them in the most abstract possible sense, whether the law would be different after this than it had been before. That is a particular kind of bravery, a quiet kind, not the bravery of dramatic confrontation, but the bravery of endurance, of showing up, of putting your name on something and letting it be used. Let the quiet settle around you. You are breathing slowly. The case law is moving in the background like water in a deep river, steady and purposeful. Not all the women who fought back came through the courts. Some came through Congress. The Equal Credit Opportunity Act was signed into law in October of 1974. Its passage was the result of a sustained campaign by women's organizations, consumer advocates, and sympathetic legislators who had heard too many stories like the one we have been telling, women with good incomes and good credit history who could not get loans in their own names, women whose financial identities disappeared upon marriage or re-emerged in shattered form after divorce or death. The hearings that preceded the bill's passage were, in retrospect, a remarkable document of how the financial system worked for women, or, rather, how it did not work. Women came forward to testify. They brought their paperwork. They described their encounters with the template. There was the woman who had worked for 20 years at the same company, who had been given a promotion every 3 years, whose annual performance reviews were uniformly excellent, who applied for a mortgage and was told her income could not be counted because she was female. There was the woman who had a better credit score than her husband but could not get a credit card in her own name. There was the widow who discovered upon the death of her husband that the 30 years of credit history they had built together existed only in his name, and she was, financially speaking, a newborn. The hearings built a record. The record built a case. The case built a law. The Equal Credit Opportunity Act prohibited creditors from discriminating against credit applicants on the basis of sex or marital status. It required that credit history be reported in both spouses' names. It required that a creditor's reasons for denying credit be provided in writing upon request. It made the template for the first time legally impermissible. The law was not perfect. Its enforcement was uneven. It had loopholes that took years of additional litigation and regulation to close. It did not, by itself, immediately change the practices of every bank in every city and every state. Culture changes slowly, and the template was deeply embedded in the culture. But it was a law. It put a marker in the ground. It said, this far and no further. After October 1974, the machinery of ordinary discrimination had a legal name, and the people it harmed had a legal remedy, and the institutions that practiced it had legal exposure. That is not nothing. That is, in fact, quite a lot. The laws matter. The court cases matter. But the texture of history is also made by people who never appear in court, never testify before Congress, never have their names attached to anything that gets remembered. It is made by the daily choices of ordinary people who encounter an obstacle and decide, without fanfare, to find their way around it. We have been following the composite woman who walked into the bank in 1971. Let us follow her a little further. After the meeting with the loan officer, she spent some weeks in a state that was part anger and part calculation. The anger was clean and simple. The calculation was more complex. She and her husband talked through their options. The first option was to apply for a mortgage based on his income alone, which would qualify them for something, not the house they wanted, but something smaller, something that would get them into the market. The problem with this option was that it required her to accept the logic of the bank's decision, to act as though her income truly did not count, truly was not reliable, truly should not be included in the household's financial profile. She found this difficult to stomach. The second option was to go to a different bank. Not all banks applied the template with equal rigidity. There were, already in 1971, loan officers at some institutions who were more willing to consider a wife's income, particularly if it was long established and clearly stable. The search for such an institution was time-consuming and sometimes humiliating. It required explaining the same financial circumstances again and again, encountering the same skepticism with varying degrees of politeness. But it was not impossible. The third option was to wait, not passively, to wait while the laws changed, while the culture shifted, while the template weakened under the pressure that people like Ginsburg and the congressional witnesses and the women's organizations were applying to it. The early 1970s, if you were paying attention, had the feeling of a period in which something was about to break open. There was an energy in the women's movement. The marches, the hearings, the books, the organizations, the persistent and accumulating pressure on every institution that had been built without women's full participation, that suggested change was coming. It was possible, if you were patient and strategic, to position yourself for the moment when the institutional barriers came down. She tried the second option first. She went to 3 more banks. At the 4th, she found a loan officer who was, perhaps, more willing to look at the actual numbers rather than the template. He considered both their incomes. He ran the ratios. He said cautiously that the numbers worked. She got the mortgage. Not without difficulty. There were additional requirements, additional documentation, a slightly higher interest rate than she thought was justified. But she got it. She bought the house. The house had a yard. She remembered years later the feeling of signing the papers. Not just joy, though there was joy, but something more complicated. A sense of having gone around an obstacle that should not have existed. A slightly queasy satisfaction in the success, shadowed by the knowledge of how many women had encountered the same obstacle and had not found the same way around, had rented for another year, had stayed in a smaller apartment, had simply, without making a fuss, accepted the structure that was telling them their income did not count as much as their husbands'. The women who did not find the way around the obstacle accumulated. They accumulated into a social fact that was large enough by the early 1970s to be politically visible. Consider the numbers for a moment, slowly, without urgency. By 1970, women constituted 38% of the American labor force. That number had been growing steadily since the Second World War, and it was going to keep growing. Women were working, women were earning. Women were, in increasing numbers, the primary breadwinners in their households, through choice, through circumstance, through necessity. The model of the male breadwinner and the female domestic worker, which had never been universal even when it was dominant, was becoming less and less descriptive of how American households actually functioned. But the financial system had not updated its model. It was still operating as though the 1950s template were accurate, as though the women in the chairs across the desks were exceptions to a rule rather than evidence that the rule was wrong. This mismatch between the world as it was and the system as it had been built produced a kind of pressure. It produced it quietly, in thousands of individual encounters between women and financial institutions, each encounter a small compression of the larger problem, and small compressions accumulated over time tend to produce eventual releases. The release, when it came in the form of the Equal Credit Opportunity Act and the related legal changes of the mid-1970s, was not a sudden rupture. It was more like the moment when water that has been filling a vessel finally reaches the brim and begins quietly to overflow. The pressure had been building for years. The change, when it arrived, had the quality of inevitability, as though this had always been where things were heading, and only the precise timing had been uncertain. But the inevitability of historical change is always a retrospective construction. To the women who were living through it, it did not feel inevitable. It felt uncertain and contested, and sometimes exhausting. The template was persistent. It had advocates, sometimes passionate ones, who believed that sex-based distinctions in financial life were not discrimination but prudence, not bias but actuarial fact. The argument that women were higher credit risks, that their incomes were less reliable, that the financial system was simply responding rationally to measurable patterns. That argument did not disappear with the passage of a law. It mutated. It found new forms. It continued to influence practice long after it had been made legally impermissible as explicit policy. You are beginning to drift a little. That is good. The story continues in your mind even as consciousness loosens its grip. You do not need to follow every detail. You can let the words wash over you, let them carry you. The immediate costs of mortgage discrimination were visible, at least to the women who experienced them. The mortgage denied, the house not purchased, the equity not built. These were concrete losses with concrete financial consequences. The hidden costs were larger and harder to calculate, and they spread outward from the individual to the household to the community in ways that compounded over time. Consider the wealth gap. The racial wealth gap in the United States has been extensively studied and documented, and its origins in housing discrimination, thus in redlining, in the differential access to the GI Bill's mortgage programs, in the racial covenants that barred black families from certain neighborhoods, have been traced with considerable precision. The gender wealth gap has received less attention, partly because it overlaps with the racial wealth gap in complicated ways, partly because it operates through different mechanisms that are harder to isolate, partly because it was less visible as a political fact in the years when these policies were being challenged and changed. But the gender wealth gap is real, and a significant part of its origins lies in the mortgage discrimination of the post-war decades. Home ownership is one of the primary mechanisms by which American families build intergenerational wealth. A home purchased in the 1960s for $20,000 was worth, by the 1990s, something considerably more. In many markets, something considerably more than that. The family that owned that home had, over 30 years, been building equity while paying down the principal of a loan. At the end of those 30 years, they owned an asset they could sell or pass to their children or borrow against to fund other investments or major expenses. A family that rented for those same 30 years had paid, over the course of that time, an enormous sum of money to a landlord. They had built no equity. They owned nothing at the end of it that they had not owned at the beginning. The money they had paid had made their landlord wealthier, not themselves. Every woman who was denied a mortgage, or who was effectively denied one by having her income excluded from the calculation, was a woman whose family was less likely to be in the first category and more likely to be in the second. And that difference, compound interest over 30 years in reverse, is one of the mechanisms by which wealth gaps widen and persist across generations. This is not speculation, it is arithmetic. The communities that were most affected by mortgage discrimination, communities with higher proportions of female-headed households, communities where women's employment was concentrated and mortgage denial rates were high, show in historical data correspondingly lower rates of home ownership, lower rates of intergenerational wealth transfer, and persistent gaps in financial stability that track closely with the period in which discriminatory practices were most entrenched. The implications reach beyond the individual household. A neighbourhood where fewer families own their homes is a neighbourhood where community investment is lower, where the physical fabric of the housing stock is less maintained, where the institutions that depend on stable residency, schools, local businesses, civic organisations, have less stable foundations. Mortgage discrimination did not only harm the individual women who encountered it, it shaped the communities in which those women lived in ways that took decades to work their way through the system. These are large thoughts for a quiet hour. They are also true thoughts, and true thoughts, gently held, can accompany you into sleep without disturbing it. The international dimension is worth a brief note, because the United States was not alone in this pattern, and the comparison is instructive. In Britain, similar practices prevailed through much of the same period. Married women were routinely denied mortgages in their own names well into the 1970s. The Sex Discrimination Act of 1975 and subsequent regulations changed the legal framework, as the Equal Credit Opportunity Act had done in the United States, but the cultural practices embedded in lending institutions changed more slowly than the law. In France, the Matrimonial Regimes Act of 1965 had actually made significant changes to married women's economic independence, giving them the legal right to open bank accounts and conduct financial transactions without their husband's authorization. But legal rights and institutional practices were, as ever, different things, and the gap between what women were theoretically entitled to do and what they encountered when they actually tried to do it persisted for years. In Sweden, where the welfare state and gender equality policies are developed along somewhat different lines, the practices were in some respects more progressive, but even there, the financial system had its own versions of the template, its own ways of discounting women's economic credibility, that had to be actively dismantled rather than simply left to dissolve. The pattern was not universal in its details, but was recognizable across every developed economy of the post-war period. It was the product of a common set of assumptions about gender and economic life that had been built into financial institutions across the Western world, institutions that had been designed by men, for men, on the basis of a model of economic activity that centered men's participation and treated women's as derivative, supplementary, and inherently uncertain. The dismantling of this pattern, which began in the United States in the early 1970s and continued unevenly for decades, was part of a larger renegotiation of the relationship between gender and economic participation that was happening across the developed world in this period. It was connected to changes in labour market policy, in family law, in reproductive rights, in educational access, in all the structural conditions that determined what it was possible for a woman to do with her life and her money. These connections were not always visible to the people making them. A woman pressing for the right to get a credit card in her own name was not necessarily thinking of herself as part of an international movement to restructure the relationship between gender and capital. She was thinking about the credit card. But the credit card and the mortgage and the court case and the congressional testimony and the law and the regulation were all connected, threads in the same cloth, pulling in the same direction. Sleep is pulling in its direction too. You can feel it. Let it. October 28th, 1974, the Equal Credit Opportunity Act became law. The bill had moved through Congress with a speed that surprised some observers, which suggests that the problem it addressed had been building pressure long enough that when the release came, it came quickly. The financial industry did not resist as strenuously as it might have. Some of the larger banks, in fact, supported the bill, or at least did not actively oppose it, partly because they had already begun, in anticipation of the political direction of things, to move away from the most egregious practices, and partly because the legislation, as written, was not so draconian as to threaten their fundamental operations. It regulated how they could use sex and marital status in credit decisions. It did not mandate that they approve any particular application. It was, in the language of the time, a civil rights measure. It moved lending decisions away from categorical discrimination toward individual assessment. In practice, the change was significant. Banks rewrote their underwriting guidelines. They could no longer explicitly exclude or heavily discount a wife's income on the grounds that she might become pregnant. They could ask about income, that was fine, that was necessary, but they could not apply a category to the income that reduced its value based on the applicant's sex. They had to treat a woman's stated income with the same presumption of continuity they applied to a man's. This did not mean that every application was now decided on purely neutral grounds. It meant that the decision had to be justified on grounds other than sex. If a loan officer wanted to discount an income, he had to be able to articulate a non-discriminatory reason. Instability of employment, short tenure, documented history of earnings fluctuation. He could not say, because she is a woman. He could not say, because she might get pregnant. The enforceability of this was, in the early years, imperfect. The Federal Reserve Board was designated as the primary enforcement agency, with responsibility for writing the implementing regulations. Those regulations were issued in 1975 and took effect in 1976. They specified in considerable detail what creditors could and could not do. They could not ask about birth control practices or childbearing intentions, could not discount income based on sex, could not require a husband's signature on a woman's application if the woman met the financial criteria on her own. The requirement about credit history reporting, that accounts be reported in both spouses' names, was particularly important and particularly slow to fully implement. Credit bureaus had to restructure their databases. Banks had to change their reporting practices. The result was not immediate, but it was, over time, transformative. Women began for the first time to build credit histories that were their own, that would survive any change in their marital status, that would be there when they needed them. The cultural change was slower than the legal change, as cultural change always is. Practices that have been embedded in institutions for decades do not disappear when a law is passed. They adapt, mutate, find new forms, or simply continue in attenuated versions that technically comply with the letter of the law while resisting its spirit. There were, in the years after 1974, documented cases of lenders continuing to ask about childbearing plans in ways that were newly illegal. There were cases of women's incomes being discounted through ostensibly neutral criteria that in practice fell more heavily on women than on men. There were cases of single women being subjected to extra scrutiny that was difficult to distinguish from the pre-1974 practices because the scrutiny was dressed in different language. The law created a monitoring mechanism, and that mechanism, imperfect as it was, created pressure. Complaints were filed, investigations were conducted, regulatory guidance was issued. The financial industry learned over time that certain practices created liability, and the fear of liability is a powerful motivator, even when other motivations are absent. By the end of the 1970s, the landscape of women's access to credit had changed substantially. Not completely, not without persistent imperfections, but substantially. Women were opening credit cards in their own names. Women were getting mortgages. Women were building credit histories that were theirs. The template was not gone, it never fully disappeared, but it had been weakened, its authority undermined, its claim to be simply the way things were made untenable. The story was not over. Stories like this are never over. The specific practices of the 1970s gave way to new practices, subtler and harder to name, that have their own history, their own slow movement toward or away from equity. But the chapter of explicit, systematic, legally sanctioned credit discrimination on the basis of sex had an ending, and the ending was the Equal Credit Opportunity Act, and the people who made it happen were real people who had decided that the template was wrong and spent years of their lives trying to change it. Breathe. The room is quiet. The story is arriving at its latter passages now. Every story leaves an inheritance. The story of the 1970s mortgage discrimination, its causes, its effects, its dismantling, left several. The most tangible inheritance was the law itself. The Equal Credit Opportunity Act of 1974, amended and strengthened in subsequent years, remains in force. It has been extended to prohibit discrimination on additional grounds beyond sex and marital status. Race, colour, religion, national origin, age, and the receipt of public assistance are now also protected categories. The law has been interpreted and reinterpreted through decades of litigation and regulatory guidance. It is not a perfect instrument. No law is, but it is part of the framework within which financial institutions operate, and its presence has consequences. The credit reporting requirements, in particular, have had effects that reach beyond mortgage lending. The requirement that married women build their own credit histories, that accounts be reported in both spouses' names, changed the financial architecture of marriage in ways that continue to matter. A woman who divorces today, and many women do divorce, does not face the credit void that her counterpart in 1970 faced. She has a history, she has a score, she has the accumulated record of her own financial life, attributed to her, available to her, portable. This is not a small thing. This is the product of specific legal choices made in the 1970s by specific people who decided that the template was wrong. The second inheritance is harder to quantify. It is the change in consciousness, the expansion of what it is possible to expect, to demand, to consider one's due. The women who fought the credit discrimination battles of the early 1970s were fighting not just for themselves, but for the women who would come after them, who would take for granted the access to credit that their predecessors had to fight for. Taking things for granted is not ingratitude. It is the way progress works. Each generation inherits the gains of the last and starts from a different baseline, and the baseline of the women of the 1980s and 1990s was materially different from the baseline of the women of the 1960s because of what had been done in the years between. The women who enter banks now, who apply for mortgages online, who build credit histories from the moment they turn 18, who have their own accounts and their own scores and their own financial identities independent of anyone else's, are living in a world built partly by the women who testified before Congress in 1974, by the women who sat in Ruth Bader Ginsburg's office and agreed to become plaintiffs, by the women who went to 4 banks looking for one that would count their income. They almost certainly do not think about this. Why would they? The baseline is the baseline. The world is the world you're born into. But the baseline was made. Someone made it. A lot of someones, working separately and together, in courts, and in Congress, and in bank lobbies, and in living rooms, made the baseline what it is. The third inheritance is more ambiguous. It is the persistence of the wealth gap, the accumulated compounding of the years when the template was in force. The women who were denied mortgages in the 1960s and early 1970s, or who were effectively priced out of home ownership by the discounting of their incomes, missed the most extraordinary period of American housing appreciation. The houses they did not buy were worth, by the 1990s and 2000s, multiples of what they would have paid for them. The equity they did not build was the foundation of the middle-class wealth that was not passed on, or not to the extent it would have been if the access had been equal. This is not a grievance to be nursed on a quiet evening. It is simply a fact about how wealth works, how advantage compounds, how exclusion compounds, how the effects of past decisions continue to ripple through the present, in ways that are not always visible, but are structurally real. The wealth gap between men and women in the United States today, a gap that is distinct from, though related to, the income gap, has roots in the housing market discrimination of the post-war decades. It has roots in the credit discrimination of the same period. It has roots in the legal structure of marriage and divorce that prevailed before the reforms of the 1970s. These roots are old, and some of them go deep, but they are not permanent. The soil has been changed, the conditions are different, the rate of change has shifted in some measures. There is more still to be done, as there is always more still to be done, but the direction of change over the past 50 years has been, if inconsistently, toward equity. The story, like all good stories, ends where it began, in the quiet of an ordinary evening, in a world that has been changed by the people who lived in it and refused to accept that the template was the only possible template. There is a house. It does not have avocado green appliances. It has a yard, and in the yard there is a tree that has been there for 30 years. The tree was planted by the woman who bought the house, the woman who went to 4 banks, who found the loan officer willing to look at the actual numbers, who signed the papers with a feeling that was joy, and also something more complicated. The tree is large now. It gives shade in summer, and drops its leaves in autumn, and stands bare and patient through winter, and puts out new leaves every spring with the reliable persistence of things that are rooted in the ground. The woman is older now. She has lived in this house for decades. She has paid the mortgage and paid it off and owns the house outright, which means she owns the tree and the yard and the 3 bedrooms, and the memory of every meal cooked in that kitchen, and the knowledge that the asset she was told could not include her income is now entirely hers. Her daughter grew up in that house. Her daughter got her first credit card in her own name, at 18, which was not a remarkable thing in the year she turned 18 because the law had made it unremarkable. Her daughter bought her own house, later, with a mortgage in her own name, without a male co-signer, without anyone asking about her childbearing plans, on the basis of her own income and her own credit history and her own demonstrated capacity to repay a debt. Her daughter does not think much about the women who made this possible. Why would she? The baseline is the baseline. The world is the world you were born into. But the baseline was made, and the making of it is part of the story of how the world works. The slow, unglamorous, persistent work of people who look at the template and say, "This is wrong, and I am going to do something about it, and I am going to keep doing something about it until something changes." The women of the early 1970s were not, for the most part, asking for anything radical. They were asking for what the system promised: equal treatment under its own rules, count my income, let me build credit in my own name, treat my application on its merits, do what you say you do. The radicalism, if there was any, lay in the premise, in the insistence that women were full economic persons, fully capable of earning and spending and saving and borrowing and repaying, fully deserving of the status of creditworthy, fully entitled to the same access to the mechanisms of American financial life as their husbands and brothers and fathers. This premise was not, by 1971 or 1974, a new one. It had been made before, many times, in many forms, but it had not yet been made legally binding in the specific domain of credit. That was the work of the years we have been discussing, and that work, once done, was not easily undone. Laws can be repealed, precedents can be overturned. Nothing in human history is truly permanent, but the entrenching of a right, the embedding of a protection into the legal framework and the cultural assumptions of a society is a form of work that, once completed, creates its own inertia. Undoing it requires active effort. The passage of time and the generation of people who have grown up with the right as part of their baseline creates a constituency for its defence. The women who fought for the Equal Credit Opportunity Act built something that will outlast their particular moment. They built a legal norm. They built a set of expectations. They built a world in which the template, the assumption that a woman's income does not count, that a woman alone is insufficient, that the fundamental unit of financial credibility is male, had been formally rejected and legally penalised. That world is the world you live in. It was built for you, not by destiny, not by the inevitable progress of history, by specific people making specific choices in specific circumstances that were not easy and were not guaranteed to succeed. You do not need to hold all of this tightly. Let it rest, let it drift. The story is almost finished. The house is quiet now. It is late. The last light has gone from the windows, or the first grey of morning has not yet arrived. Either way, it is the deepest part of the night, when the world is still and all the noise of living has gone somewhere else for a while. Think, if you like, of a house, any house, a house where someone sleeps, a house where the heat ticks on in the small hours and the refrigerator hums and the floorboards settle, a house that belongs to someone. That was bought by someone with a signature on a document and money exchanged and a key in a hand. A house that is, in the long view of things, one small piece of the world that was claimed and held and passed on. Think of the hands that signed the papers, the hands of women who were told their income did not count and found a way anyway, the hands of lawyers who argued for years before courts that were not always sympathetic, the hands of legislators who held hearings and wrote bills and cast votes that nobody thought would change very much, and that changed a great deal. Think of all the mortgages in all the names of all the women who came after 1974, who never knew there had been a time before, who assumed, as one naturally assumes the air one breathes, that this had always been how things worked. The tree in the yard is still there. The house is still there. The law is still there. You are still here. Let the thought soften now, like the last ember in a fireplace. Let the warmth of it spread through you. Not urgency, not the heat of argument, just the quiet warmth of knowing that the world has been made, incrementally, by people who cared enough to make it. And now let sleep come for you. It has been patient. It has waited through the whole story. It is here now, at the edge of consciousness, gentle and unhurried. Let it. Thank you so much for watching. If you enjoyed this story, please consider leaving a like and subscribing to the channel. It truly helps us continue making more content like this. See you in the next one. If you were a woman in 1971 and a bank told you your income could not be counted because you might get pregnant, what would you have done? Would you have fought back, found another bank, or simply accepted it as the way things were? Let us know in the comments below.